Good afternoon, everyone, and it's nice to meet you all. I'm assuming you can see my full PowerPoint and you can hear me okay?
Yes.
Okay, great. So what I would encourage you to do, what I would encourage everyone to do, is if you have a question as I go along, please feel free to interrupt, either jump in and just speak up, or go to the chat, and then Angie can get me to pause and answer any questions that you might have. So I'd like to keep it somewhat interactive, because I tend to sometimes go over things, maybe not explain them as much as I could. So please don't hesitate to interrupt at any time. So here's me, budding entrepreneur back in 1975, University of Waterloo spin-off company that I created, turned it into a global company making video display terminals. And I look here, as probably many of you do now, except I suspect you're probably not wearing three-piece suits. This was the fashion in those days. And of course, we wanted to look like, entrepreneurs wanted to look like serious business people, so we wore three-piece suits. So here we are selling our products, video display terminals, just around the time that Apple got started and just before desktop PCs became very popular. Interestingly, as a little segue, I should mention that we exported these products around the world, including to Korea. And one of the conditions of exporting to Korea was that we found a local partner. And that local partner was a tiny little company. Well, not so tiny, actually. It was a large company involved in hotels and freight and shipping and manufacturing, but not very well known in electronics. And that was a company called Samsung. And in order to sell our products in Korea, we ended up getting Samsung to make the monitors, the video display part of our terminals. And that is actually how Samsung got into the video business. They were making televisions at the time, but I take great pride in mentioning that we actually got them started in the monitor business. So a few years after this photo was taken, in the early 80s, I sold the company and then decided, okay, what's next? And as I hope you're beginning to learn as entrepreneurs, is that being an entrepreneur is really a 724, 365 undertaking. You really have to be quite dedicated and committed to your venture. So after selling it and talking to my wife, she said, wouldn't it be nice if you could meet your kids? You've been working so hard and you hardly know them, and maybe now's the time to kick back a little bit and do that. So we did that. We traveled a lot, and I decided that rather than go right back and start another new venture, wouldn't it be fun to work with others who are starting their companies? Maybe help them with a little bit of investment money, maybe some mentoring, maybe with some of the connections that I had. And so ever since then, I've been basically doing what we now call angel investing, although that term wasn't known back in the 80s, at least not in the high-tech industry. So today, I want to really cover two topics. The first one is how to engage with angel investors, because I think all of you, when you look for capital, that's really your first stop, other than maybe family and friends, but engaging with angels will really get you going. And secondly, and related to that first objective, is how to win the New Ventures BC competition, because the two are very closely linked. Angel investors, many of them are judges in the New Ventures competition, are looking for certain things. And in fact, it's what angels are looking for that helped us at New Ventures formulate the questions that we'd like you to answer to determine whether you are a potential winner or not. And both of these topics, or both of these objectives, require you to make a compelling business case. And that all comes down to making money. And it means for you to show how you're going to make money in your venture. And secondly, how investors are going to make money if they invest in your new venture. So to begin with, I'd like to just talk about some local success stories, because it's always great fun to look at others like you who've been there, done that, who have built successful companies. And I find that usually to be inspirational. Plus, and also very importantly, a lot of these people are here today to help you with your venture. Just like I did when I sold my company and I decided that I wanted to work with others, a lot of the angels or entrepreneurs that have now built and sold their companies, they've now got capital and hopefully some time that they can use to help you get you off the ground. So just a couple of companies that I'll mention here that have happened just in the last year, in fact, even in the last few months. And some of them, in fact, 3 on my list here are New Ventures finalists, and New Ventures, not just finalists, but winners. Abcelera is one that comes to mind. Abcelera is a company out of UBC that went public just before Christmas, and they raised $500 million on their public debut at a valuation of over $15 billion. There was an article in the Georgia Straight that talked about Carl Hansen, the founder of Abcelera, who is now worth $4 billion, that's B like Bob or boy, $4 billion. And I found that really interesting because some of our most famous entrepreneurs in British Columbia, like Jimmy Pattison, for example, who's always been at the top of the list, you know, it took him decades to build his fortune and get up into the billions of dollars. And here you have Carl out of UBC, $4 billion in under a decade. Very, very phenomenal outcome. A couple of other companies here that I'll mention that were involved with new ventures. There was Dark Vision, Stephen Robinson, second-time entrepreneur. He had another company that he formed before Dark Vision. That company was sold to Koch Industries, and I just give an approximate value here because of confidentiality reasons, but it was well in excess of 50 million. Similarly, Neurial, founded by 2 young female engineering graduates from UBC, sold out to Generac just 2 years ago, actually almost 2 years ago to the day, also for well over 50 million. Another company that I'd mention is one that I invested in just 1 year ago, actually in January of last year. And in less than 10 months, they sold out to a Toronto company called Intellex. So that's a pretty fast outcome. You might have heard of the E-myth. The E-myth is really the belief, it's actually, a book was written by Michael Gerber titled The E-myth. And in that, he basically, his thesis was that most entrepreneurs are really not entrepreneurs. They are really technicians suffering from an entrepreneurial seizure. And by that, he meant that, you know, just because you're a good developer or a good chemist, or because you know a lot about clean tech, that doesn't mean that you can necessarily run an enterprise that uses those skills or has to do with your vocation. So there's a lot more that you have to know in addition to being a technical expert. And many entrepreneurs, probably many of you in the audience today, have very little or no business experience. And you might want to ask yourself, is this really for you? Because you're going to have to learn a lot about business and a lot about finance in order to live your dream and commercialize your idea. I believe that there are really just 2 success factors that make companies successful, such as those companies we just took a look at. And that's number one, you, people, you and your team, your experience, fact that you're willing to take some risks, and very important, a total commitment to your idea and to your project. Here we see Steve Jobs and Steve Wozniak playing around with their first products, the Apple. And secondly, of course, you need capital. You need money, and you need enough to get you to the point where you're cash flowing and able to sustain your venture. I'll give you some observations, things that I've seen over the past few decades. Number one, good companies will always get funded. I'm always concerned when I see reports or articles where entrepreneurs say, oh, you know, there's just no money out there. There's no help for me. There's no support. Believe me, it's just not true. If you've got a good proposition and good people behind it, you will get funded. There's absolutely no question in my mind about that. Startups are getting better each year. Organizations like New Ventures BC contribute to that. We try to make you better at presenting your opportunity, better at attracting investors. One phenomena that we've seen just in the last year or so is that there is more and more capital available. Some of that is, of course, from entrepreneurs who have just cashed in and sold their companies. But there's also a lot of venture capital, a lot of government money. Just yesterday, the government of British Columbia re-announced the NBC Venture Fund of $500 million they want to make available to growing technology companies in British Columbia. And there are not only new angels being formed, but angels working together to create angel funds. Now, having said that, one thing you should be aware of, and of course, investors, angels know this, and that is the fact that unfortunately, many of you will fail. In fact, about half of you will probably fail in the first 5 years. And maybe as many as 80% will fail in 10 years. But still, don't let that discourage you. This is the best time ever to raise capital and get your business launched. It's also a great time to start a company. You know, prime rate is very low, which is good because investors are looking for better ways to get a return on their capital. Inflation is in check. And this year, BMO and others forecast the GDP is going to grow at the rate of about 6% in Canada. Now, admittedly, it was down a bit last year because of COVID, but the growth is good. That means the economy is bustling, people are investing, people are buying products, hopefully your products. Even though governments are tending to increase taxes, and of course we'll see taxes rise because of all of the spending on COVID incentives and COVID relief programs, there are still many great reasons tax-wise to start a company. You have, of course, the small business corporation tax rate, and you have the capital gains exemption rate, which means that you as an entrepreneur can make around $900,000 completely tax-free when you sell your company, which is a wonderful incentive. And everyone that invests in your company can benefit from that capital gains exemption. We also have a lot of support for R&D. We have the scientific research and experimental development tax credits, which can contribute or pay you back up to about 68% of your eligible R&D expenses. We also have great infrastructure here, especially here in British Columbia. There are many accelerators, incubators, funds, organizations, industry groups that are out there to help you along the way. one of the special incentives that we have here in BC, and BC is very unique in this regard. In fact, British Columbia is the envy of the world, many say, because BC will give investors a 30% refundable tax credit when they invest in your company. So for example, if I put $100,000 into your venture, I will get back $30,000 from the BC government when I file my tax return. Whether or not I owe taxes or not, I will get that benefit. And of course, that means I have 30% more that I can invest in your company or in other startups. And another good reason to start a company is because, you know, creativity is one of those wonderful things where there are still so many uninvented things. And finally, of course, no matter what you might come up with, I'm sure that if you push it hard enough, you'll find someone in America that will like it and buy it. Let's take a quick look at the tech sector in British Columbia. And it's grown quite dramatically in the past few years. In fact, it may not actually be a great thing for you insofar as that it is becoming more difficult to attract skilled people to your company. Currently, there are about 125,000 some jobs in the tech sector. Last year, more than $100 million was put by angel investors into British Columbia startup companies because of those tax credits that are made available by the British Columbia government. And revenues of the tech sector are now up to about 35 billion. And that's a major contribution to gross domestic product. So we're in a really good place at a really good time. And again, as I said earlier, feel free to jump in with questions at any time. Now we're going to get into some of the interesting things about angel investing and early stage financing. This chart here comes from the NACO website, the National Angel Capital Organization, and it shows different sources of funding that are available to you throughout your various stages of development. Angel investors generally get involved just a little bit after the idea stage, or maybe even at the idea stage of development or proof of concept. And they will be there to support you right up until the maturation stage, right up until you raise serious venture capital or go public or sell out to another company. Now you'll see I have a few X's on this slide. And what I've X'd out there is what they refer to as the valley of death, meaning that that's where it's very difficult to obtain funding. But I've called that opportunity because I think that's where the great opportunity lies for angel investors and where you can take advantage of that opportunity. Let's talk a little bit about access to capital. And I have a website, by the way, called moneylinks.ca, which you can go to. And in that, I list a lot of the sources of equity capital that I'm aware of, as well as sources of government funding and even debt financing. So usually when someone starts a company, they will go to the bank of mom or dad and get a little bit of help, or Uncle Edwin or whoever will come along and give a little bit of support. But family, friends, and relatives only go so far. Most recently, we've seen crowdfunding, and there are now portals where you can go to. In Vancouver, for example, there's Front Funder, an excellent place to go to sell shares. 5 or 6 years ago, you couldn't do that. It was prohibited. I'll talk a little bit more about that in a moment. Of course, there's also product crowdfunding where you can raise money against a project, which is probably even better than raising capital for equity because you're not giving up any ownership. when you sell your products. The junior public markets are doing quite well, and lots of young companies are going public on, for example, the Canadian Stock Exchange or the TSX Venture Exchange. And personally, I think that's a good thing to do if you have very ambitious plans and if you want to build a large enterprise rather than just build a company to the point of being able to sell it to a larger company. But that's not easy to do and takes a lot of time and know-how. And then, of course, there are angel investors. And angel investors are great, but they are a small percentage of the population. And I'm going to explain a little bit more about what we mean and what defines an angel investor. But for now, just remember that there are not that many of them. And the challenge is for you to connect with them and find out where they're hiding and how you can pitch to them. Here's my favorite example of how crowdfunding was used for the Pebble watch. You can see here that $10 million was raised against this concept by 68,000 backers. And if you ask me, if you can raise $10 million like this, it's certainly much better, certainly better for you than to go to investors. In fact, it's probably a good idea to do both, because when you do product crowdfunding and you get this kind of traction on your product, investors really like that because it validates what you're doing and it tells them that there's an appetite for your idea. Now, I want to throw in a little spoiler, and a lot of people still do not know this, and I suspect that many of you today may not be aware of this. It's important for me to mention it because I don't want you to be breaking the law. It's not that you're going to go to jail. You might get a slap on the wrist, and it may make it difficult for you to raise capital in the future. But keep in mind that it is illegal for you to sell your shares to someone that you don't know unless you use a prospectus, which is kind of like a business plan with a lot of legal red tape around it, and that you are a registered dealer who is allowed to sell securities, i.e. shares, to the general public. So unless you have a prospectus and are registered, you cannot just sell your shares to anyone. There are exceptions to that. We call these exemptions. So you can use an exemption to the requirement to have a prospectus and be registered. And I'll talk a bit about what some of these exemptions are. These exemptions and these rules and regulations are as a result of our securities regulators, which operate in each province in Canada. It's always been a pet peeve of mine that we have so many regulators. For example, we have the BC Securities Commission in British Columbia, and we have the Ontario Securities Commission in Ontario. And although the rules are somewhat harmonized, there are some subtle differences. And for an entrepreneur to sell shares to an investor in Ontario is not as easy as it is for a BC entrepreneur to sell shares to BC investors. So there are provincial barriers, let's call them, to raising capital. And I think it's a result of our regulators being provincially authorized. It would be nice if we just had a national regulator, much like we see in the United States, but I don't think that's going to happen at any time soon in Canada. And it's not about business and it's not about entrepreneurship. It really has to do with constitutional rights. And it's an ongoing battle between the provinces and the federal government. But enough said on that. What's important for you to remember is that these are the rules and you have to live by them. And they're there ostensibly to protect investors, especially poor ones. But rich investors, like angel investors, we don't have to worry about protecting them. That may seem a little bit funny, but that's the way it is. Now, let's define what a business angel is. So first of all, it's usually 99 times out of 100 a successful entrepreneur. Someone who's been there, done that, has been in your shoes, knows what it's like to worry about meeting payroll on a Friday afternoon. Business angels like to give back not only some of their time, but some of the money that they may have made when they sell their ventures. They like to mentor you. They like to coach you. They want you to be coachable and receptive. But the formal definition is that an angel investor is also an accredited investor. An accredited investor is defined in the securities regulations that I mentioned a few moments ago. And the definition is that you have to be either a millionaire, which means that you have to have more than $1 million in liquid net assets, not counting your residence, because after all, in Vancouver, everyone would be a millionaire. So that doesn't count. It would only count what's in your bank account and in your stock accounts and those kinds of accounts. Or you could be a high income earner. So you may not yet have saved up $1 million, but maybe you're getting a paycheck of more than $200,000 a year. That would qualify you and define you as being an accredited investor. You could also, with your spouse or partner, be earning $300,000 a year, and that would also qualify you. And to be able to invest in a startup and to be able to use the so-called accredited investor exemption, you have to be able to meet this financial test. If you go by the income rule, that limits the number of potential investors to actually only about 1%. But when you take into account the millionaire component, that brings it up to closer to 4 or maybe even 5%. So let's take a little look at why angel investing is attractive, aside from the fact that angels like to give back some money and time to new ventures. A number of years ago, Rob Wiltbank, professor at Willamette University in Oregon, did a study, a very seminal study on the returns to angel investors. And he looked at thousands of companies. And what I'm showing you here is a summary of that. And the bottom line is actually shown at the top of this slide here at 27% compounded annual rate of return on average. This is all about averages. So if you're an average angel investor in North America and you invest in the average number of companies, etc., you will earn overall on your portfolio a return of 27%. Now, when rich people look at asset classes that they could invest in, this stands out as being extremely attractive. You can play the stock market, and if you're lucky and you're in mutual funds, you may over time, over 20 or 30 years, earn 10%, let's say. Same thing with real estate. Over time, you're always sort of stuck in that 10 to 15% band. If you stick your neck out a little further and you get involved with some exotic financial instruments, hedge funds, commodities, futures, that kind of thing, again, if you do it right, you may increase your chances at a higher return. But bottom line is it's very difficult as an investor to get much over 15% without some real magic taking place. But angel investing, for this reason, is becoming and has become very, very popular. Another thing that I point out on this slide, and it goes back to my earlier comment about failures, the big blue bar on the left shows that more than 50% of the companies that angels invested in gave back less than the money that was put into them, usually zero or something less than even money. Some 30% produced modest returns of 1 to 5 times the capital back. And on the very right, you can see that less than 5% of the companies produced a greater than 30 times multiple return on the angel investor's investment, I should say. The green bar shows the payouts. You know, we hear of the 100 million and 500 million and $1 billion exits, but the averages are not that high. This shows, for example, that you've got about 40% of the companies that will give returns of over, or payouts, I should say, not returns, but total payouts of over $80 million. Pause just in case there are any questions. The most recent data compiled by NACO, the National Angel Capital Organization of Canada, is for 2019, and it showed that the mean valuation for startups was $6 million, and the median valuation was $4 million. And those valuations, especially recently, are increasing. This is a very, very hot time to be in the market. There's lots of capital around, and more money is chasing fewer and fewer opportunities. So how do you engage with angel investors? I like to say, make your pitch both compelling and intriguing. Like, what is going to make me want to have a private audience and learn everything I possibly can about your business? And when I say intriguing, the key thing is when you first start talking about your venture, don't say everything right at the very beginning. Leave a few questions that I'm going to want to get answers to, questions that are going to compel me to come and speak to you and have a private meeting where we can talk seriously about investing. So what are angels looking for? I would say number one, certainly at the top of my list, is fun. Angel investors don't really need to make a lot of money. They've already done that, which is why, in fact, they have money to invest in companies like yours. So they want to have a good time. And in my case, especially, I like to learn about new things. I like to learn about new technologies, new markets, new opportunities. So it's about learning. It's a learning experience. I like to see, as many angels do, entrepreneurs that are good proteges. They are keen to learn, keen to listen, keen to learn, and they're not know-it-alls. Angels like to use resources that they've developed over time. For example, their connections, their contacts in business and industry. Of course, angels also want to get a good payout on their investment. And the numbers that you will hear are 10 times to 100 times. If I put $100,000 into your company, I want you to show me how I can expect to make at least, and I say at least, 1 million back. So at least 10 times my return. Because remember, half of the companies I invest in are going to give me nothing. So if you give me 10 times return, then that gives me $1 million on $100,000. But if I've invested $100,000 in 10 different companies, I'll probably lose $500,000 or $600,000 of that. So my overall returns will not be as attractive unless I can see my way to making at least 10 times, if not more, on any individual investment.
Mike, someone's just asking if that
Yes.
investment is in how many years in an ideal situation?
So these 10 times to 100 times would be ideally in 5 to 10 years. And it's a good question because, of course, if you make, I would rather make 5 times my money in 5 years than 10 times my money in 10 years. Because if I make 5 times my money in 5 years, that's an annualized compound rate of return of about 38%. Whereas 10 times my money in 10 years works out to 27%. So I'm giving you a very broad range here, but it would be in that time frame. Now, having said that, there are many companies that I've invested in 20 and 30 years ago, and I'm still an investor in those companies. And I still haven't seen any liquidity or any payouts from those investments. So when you are pitching to angels, it's important for you to have some idea as to when that liquidity event may occur. You do not need to have a short time frame. It may exclude some investors, but that's okay. It's important for you to say what you want to do and what you want to accomplish. And if your payout is going to be 15 years, that's okay. Just let investors know that. And you will find patient investors that don't mind waiting for 15 years if they can get 1,000x rather than 100x times their money back.
Mike, just one more quick follow on. I think someone just made a comment on your 5 to 10 years saying that seems similar to VC timing. And then they have a question saying ownership difference. Is there an ownership difference?
Yeah, definitely. The venture capital funds typically have a 10-year horizon. So venture capitalists raise a bunch of money from institutions and high net worth individuals, and then they invest that money in 1 or 2 years, and they would like to ideally get paid out from all of their investments in about 10 years. It's one of the big differences between venture capitalists and angel investors. Angel investors are individuals, people, each person with a different mindset, different objectives, different goals, different tolerance for risk, and different timeframes. When I was in my 50s, I didn't mind investing in a company where the payout might be 20 years. Of course, I can only do that if I have a balanced portfolio where I have some expectation of short-term returns and some expectations of long-term returns. But a good angel portfolio will comprise investments that span anywhere from a few years to even as much as a couple of decades. And one of the beauties of angel investing, and this is again is important for everyone to understand, is that you may strike out with 20 or 30 angels, and it's that 30th one or the 40th one that you talk to that may really relate to you and like what you're doing. So, it's more difficult, let me say, to generalize with angels than it is, for example, to generalize with venture capitalists, because the model is different. Same thing is true with banks. We know how bankers think and work, and we know what the risk appetite is for bankers. Bankers, like venture capitalists, invest other people's money, but angels invest their own money. So the way they work and the way they operate is definitely not institutionalized in any way. Carrying on, then, the other thing that angels look for, and in the individual, and I kind of summarize it by calling it the 3 I's, as far as personal qualities, and let's face it, when angels invest in you or in your company, number one, they're really investing in you. And secondly, they're investing in the company. So in you, they are looking for how intense are you? How committed? how involved, how engaged. Integrity, are you honest? Are you trustworthy? Are you going to do what you say you're going to do? Or are you going to take the investment money and take a trip to Cuba or buy a Porsche or something crazy? And how responsive are you? Will you do what you can today, or will you procrastinate and let someone else eat your lunch? So timing, especially as we've seen in the .com industry, is everything. Beating the competition is everything. So those are the 3 I's. And then there's the 3 G's that I like to talk about with regard to the company itself. And I borrowed these from Milt Wong, who is a very successful British Columbia investor and entrepreneur. And in one of his award-winning speeches, he talked about what he looks for in a company is what's good about it. Why would I have a good feeling about investing in this company? And is it going to be great? Is it going to make a substantial impact in whatever way you want to define it? And finally, of course, is it going to be financially successful? Is it going to make money for me? So those are the things that Milton would be looking for in a company.
Mike, just one more follow-up question around someone, I guess they've got a hardware startup. So hardware often is a lot more initial investment and maybe results come later than software. So why would an angel investor, what are they looking for to invest in a hardware company?
Well, again, now, you saw my earlier slides. My first company was all about hardware. I mean, software was hardly invented when I started my first company. But no, seriously, I'm a big fan of hardware. I like manufacturing. I like making things. I like clean tech stuff. It's different. It does take more capital. The margins are different. There's a lot of different dynamics in hardware, but there have been many successful hardware companies. One of the ones I mentioned that was in New Ventures, Neurio, started off by making home energy monitoring devices, and they attracted capital, no problem. Again, you'll find angels who don't like hardware. It's too messy for them. It's just too complicated. And besides, all the hardware is coming from China, so why should we fuss with hardware? You'll get that kind of attitude. But then there will be those who love hardware and they don't understand software. By the same token, you'll get different industry sectors. You'll get some investors who love pharma and medical devices and biotech, and others who won't invest in that. There's if you read some investment philosophy books by people like Warren Buffett and others, they say, well, it's not a good idea to invest in things that you don't understand. Now, me personally, I like to invest in things that I don't understand because it's a good way to open horizons and learn about new things. But I also like to invest in things that I do understand. And I like to have a portfolio which spans from things that I don't understand to things that I know really well. But that's me. You talk to another angel investor and you may get a different story. So again, that's what's good about angel investing. There'll be an audience for you regardless of what industry you're in and what it is that you are attempting to commercialize.
Okay, there is one quick follow-up, Mike, but I know you want to get through your presentation. And I think the answer will depend on the angel, but someone else is asking just at what stage angels like to get involved in hardware companies, during product development, or do there needs to be traction?
Same thing. It's all over the map. Yeah, exactly. So what would you offer angels? Well, of course, you'd offer them ownership. A good rule of thumb is on your first round of investment, you would probably give up somewhere between 20 and 30, maybe even 40% equity in your company to one or more or a group of investors. You would probably give them participation, not just in equity, but maybe in governance, maybe they will, or one or two of them might join your board of directors. And that's something I highly recommend. They may also be advisors or mentors to you. And of course, you would offer them the potential of that upside gain that we covered moments ago. When you first talk to an angel investor, you will negotiate a term sheet. The Angel Forum, one of the angel venues that meets regularly, that I'm involved with, tomorrow, in fact, is doing, I think it's tomorrow, is doing a webinar, 3-hour webinar on this very topic. And term sheets vary a lot from deal to deal, but there are certain clauses and certain terms that are important for you to be aware of. And I'm not going to really get into those in great detail today. I just want to make you aware of them so that when you are ready to start engaging with angels, you'll revisit this subject. So term sheets are about valuation, and the valuation is probably one of the most important things in negotiating. You know, what is your company worth? How much of it are you going to give up for a certain percentage? And what type of security are you offering? One thing that's very popular these days is safes, and I'm going to talk about that in a minute. The amount that you're looking for, legal factors, you know, where are you incorporated? Are you a BC company? Are you a Canadian company? Have you registered for tax credits, this kind of thing? What are rights that you're giving to investors, information rights, voting rights? Are there any restrictions that investors are putting on you, like limiting your paycheck, for example? I like to limit your paycheck because I figure you're going to get the big payout when you sell your company. So I don't want to be paying you $150,000 a year. I'd rather see you have 40 or 50% ownership in the company. Vesting is important. That's a subject that usually shows up in a shareholders agreement. If there are 3 founders and you each have equal ownership, what happens if one of you quits after a year? Do those shares go back to the company, or does the person who quit just simply have them and benefit from the hard work of the others? So these are some of the things you'd put into a shareholders agreement. And then the cap table, the capitalization table, in other words, and options. Who owns the shares in the company? Who has options to buy shares in the company? You can learn about term sheets and a lot about this terminology in the Common Docs section of the NACO website. I'll talk just a moment about safes, and I'm doing that because we're seeing so many deals lately that are being done using safes. Safes evolved out of Silicon Valley at Y Combinator. SAFE is an acronym for Simple Agreement for Future Equity. I can tell you that they are actually good for you. They're good for the entrepreneur, but angel investors like myself absolutely hate safes for many reasons. I just want you to be aware of that so that when you're talking to investors, it's important that although it's good for you, you may get some pushback when you talk about safes. And I think we've come up with a solution to a safe. It's something I call a safety. It basically accomplishes the same thing, except it's a clause in a regular standard subscription agreement. The reason that safes were created was because they avoid the valuation question. They say, okay, we're going to put money into your company, but we're not going to put a value on it until you raise a huge amount of money on a much bigger investment round. I believe that these documents, even though they're called simple, they can actually be quite complex. The problem is that investors are not shareholders. They're just unsecured debt holders. They're not any party to a shareholders agreement. They may have a great risk exposure, especially if the safe never converts to equity. And so a solution that I and others are proposing is that you just simply issue plain vanilla common shares at whatever valuation, even if it's a high valuation, with a future adjustment in case that future valuation is lower than you expect it to be. So I'm not going to say much more about that because of time limitations, but I just wanted to point it out that it's a very topical discussion these days. So I want to tell you about how to connect with investors. A good place to begin, of course, is new ventures, because so many people involved with new ventures, the mentors, the judges, the directors, are to a large extent angel investors, big ones, little ones, whatever. And unfortunately, because of COVID, we don't have as many networking, in-person type networking sessions, but those are great ways to meet them. But in the meantime, the online sessions are okay too. In Vancouver, we have Vantech, which is an organization that I created over 20 years ago, and it meets every month. In fact, I should say that the next session is in a week from today, next Wednesday. And if anybody in the audience wants to attend that, I would be more than happy to invite you as my guest, no charge. You can just join in and see what it's like. You can hear some great pitches. You can meet some angel investors. You can hear the kinds of questions that are asked. And hopefully you can learn a little bit more about pitching to angels from a real live event. I want to say a quick word about angel funds, and I'll take the liberty of using my own fund, which is called the WUTIF Angel Fund, which is an acronym for Western University's Technology Innovation Fund. And my fund consists of a whole bunch of angel investors who together invest in startups. So we are looking right now, we have capital, and we're looking for startup opportunities. We like to put about $100,000 into a startup company, and we'll usually double down or triple down as the company makes progress. And we like to get involved at the very, very early stages, ideally when you're ready to commercialize, but sometimes even before that. So if any of you have a great idea and you want some initial feedback from a fund, we'd be more than happy to provide that to you. There are 3 or 4, actually now maybe more like 5 or 6 similar funds, and you can learn about them by going to the website I referred to earlier called moneylinks.ca. Now I want to get into the making the business case.
Oh, Mike, there's a few questions. Can I ask you first quickly?
Sure.
Okay, so first, is there a template available for your solution to your safety?
Yes, you can find it on my website, or you can find it here on the WUTIF website, which is wutif.ca.
Okay, I'll add those links in the chat momentarily.
Yeah, if you go to wutif.ca, you'll see a blog on it, you'll see a discussion on it, and you'll see some templates.
Okay, many people want to be your guest at the next Vantech event. Do you want me to just collect names and get them, send you a guest list, or how do you want people to do that?
Yeah, either through you, Angie, or they can, at the end of the presentation, I've got my email. It's just mike@volker.org. And if they send me an email, I'll put them on the guest list.
Okay, perfect. So everyone take note of that. And finally, Rob is asking, can you explain the difference between a BC angel who would want 20 to 30% versus a US investor who would only expect 15%?
I'm not sure I understand that question. It could be that by implication there, you're saying that the US investor is willing to go along with a higher valuation and take a smaller equity position. And that's, there's some truth in that. In Silicon Valley, companies are getting higher valuations. But if you go to other areas, if you go to Cleveland, Ohio, or Austin, Texas, or Ottawa, Canada, different dynamics. It depends what market you're in. One of the things with angel investing is it's kind of a contact sport. And you won't find a lot of BC investors hanging around Silicon Valley. Sure, you know, a BC angel investor may invest in California, but it's usually because a buddy has told that investor about an opportunity in California. But, you know, investors like to be nearby. They like to be near the company. They like to be able to go to the premises, meet the people, look at the facilities, and so on. So it's very unusual for entrepreneurs to get their first capital from angels who are not geographically nearby. It always starts with getting a few nearby, and then, you know, they may bring others from further afield. But depending on where you're located, you know, the numbers, the dynamics will be different. Valuations will vary from place to place. And that's largely because of competition. Obviously, if there are way more angel investors in California, that's good for entrepreneurs because they can get a better price for their shares and better valuations.
Okay, and then I don't know if you've already covered this or not, but someone's just asking if there's such thing as a bad angel investor and what you should be looking for in a
bad angel investor?
Yes.
Oh, yeah, tons of them. Yeah, I'm probably a bad one to some entrepreneurs. Who knows? You know, and I guess it depends what you mean by bad. There are those people who can be overbearing, you know, who will bug you all the time. You know, they give you $10,000 and they'll phone you every week and say, "Hey Joe, how's it going? How's my investment coming along? When are you going to be giving me a payout?" You know, so you have those kinds of people. Again, you know, it's a really great question because as much as an angel investor checks you out, you should check out that angel investor. You know, if that person has a reputation for being difficult, you might want to avoid them. There are angel investors who are very passive. All they are doing is going along for the ride. And there are those who won't invest unless they have a role to play. So again, very, very broad range of possibilities. And it's incumbent on you to do your homework and to do your due diligence on all of your investors. So let's talk a bit about the business case. And it's really not that complicated. And I usually leave this till the end because I'm going to give you a dozen or more slides that you can study on your own. It really doesn't need me to explain every single one to you. It's really just so you get the overall idea. So number one, first and foremost, what is it that you're selling? And articulating that is key. You know, and who's going to buy it and why? Why are they going to buy it? What's going to change their habit, change their behavior from whatever they're doing now to going with your solution? And then how are you going to make money? You know, what are your margins? How are you distributing and marketing your product? You may begin with the proverbial elevator pitch, and you've all heard that terminology, elevator pitch. And here again, I would encourage you to be specific and not be vague and fuzzy. So as an example, you would say, you name your company, Ace Corp, you're making, what is it? It's a personal GPS tracker for, who is it for? Parents. Why do they need it? Well, they need to know where their children are. And they need this instead of using cell phones and other gadgets because they can find out through a web browser via real-time location and so on where their kids are. So what I'm trying to do here is to form a picture. I think by reading this, you've got a picture in your mind as to what Ace Corp is doing. What does it look like? How does it work? If you can make that picture, you're one step ahead. And then here's an example. Dave Thomas uses this, and I think he's giving you one of the new venture sessions as well. So again, you know, the Apple iPod, it's for mobile high-income individuals who need a better way to listen to music, blah, blah, blah. And it's as simple as that. Now, This is the part that is usually not mentioned in a pitch. And increasingly, we are seeing this in presentations. And you will see this. Those of you who come to the Vantech meeting next Wednesday will hear this to varying degrees. And it's what the investor gets. Okay, so you would say, okay, we, same company, Ace Corp, you need $500,000. What do you need it for? Production, tooling, hiring people. What are you going to give up for that? Well, you're going to give up 30% of your common shares. And what's in it for the investor? Well, the plan is to be acquired by Polycom. And notice that I use a very specific company here. I don't just say the plan is to be acquired by a big company or a tech company. I'm specific. So I've done some homework. I know who might be interested in my company as an acquirer. And I've got a price in mind. Okay, they're going to buy it for $15 million. You can see my pitch is a little dated. Should say just change that to 2024. And that's going to give you, the investor, a 5 times return in 5 years, which is 38%. So if you can articulate something like that, investors like to hear this. What they don't like to hear is a bunch of BS. So just for fun, when you make presentations, for example, at Vantech, we like to lighten things up a little bit now and then, and we play this bingo game. And the way it works is that if you use any of these words, the angels get to cross them off if they can hear you use one of these words. And if they can score a bingo, i.e. a straight line, they say bingo, and that's the end of your presentation. Now, I just say that to throw in a little bit of humor here, but the truth of the matter is that, you know, everybody says, oh, we've got world-class products. We have a competitive advantage, and we've got this ground floor opportunity that we want to get you in on. And, you know, someday we're going to do a NASDAQ IPO. Well, these are non-statements. They are too fluffy. They are too obtuse. They're too vague. And investors will tune out. So what they want to hear is specifics. You know, be as articulate as you can.
Mike, someone was just asking, Will was asking, what are the differences between all the local angel groups? Like there's Vantech, eFund, WUTIF, I know Valhalla, etc.
Very similar. And you will find that they have a lot of the same people. For instance, I go to almost all of them. And you know, you'll find some people like one, some like the other, but it's a mixture. And again, the nice thing about it is you can go to all of them, because you know, not every angel is going to be at every event. So it's an opportunity to, like a TV commercial, to be repetitive and to pitch your wares more than once. But there isn't a great deal of difference. None of them charge a great amount. The one exception is the Keiretsu Forum. The Keiretsu Forum is a little bit later stage. They're not as interested in raw startups. So you would go to the Keiretsu group at about the same time you might go to venture capital investors, because the angels in Keiretsu are very, very serious, and they're global. It's a way that you can connect not only with angels in BC, but angels in the Pacific Northwest and around the world for that matter. The competition, getting back to the New Ventures competition, you know, I've often get asked, is it a business plan competition or is it a business competition? And the answer is that it's really both. You know, it's the business that ultimately people invest in, but it's your plan, it's your presentation that explains the business. So that's what we want to talk a little bit about in the remaining time. And what we say to the judges is that in their judgment, they have to pick the company that's most likely to be commercially viable with the greatest value. So you may have a company that is a slam dunk, but it's not, you know, it's not going to be great. On the other hand, you may have something that's kind of risky and futuristic. Maybe it's technically challenging, but if successful, it could have a humongous value, right? So somewhere in between, the judges have to pick something that is ambitious, yet something that's going to be valuable and exciting and scalable. And as far as scale goes, it's important for you to tell your story. Now, some of you will have forecasts that say you're going to hit $10 million in 5 years, and some of you are going to try to hit $100 million in 5 years. What's important is for you to say to investors what you want to accomplish. If you think the investors, like venture capitalists, for example, they're looking for the $100 million opportunities. But if that's not you, don't stretch it. Just say what you realistically want to do. What kind of a business, even if it's a so-called lifestyle business that isn't going to set the world on fire, you can still get support for it. But just be honest. And again, if you're honest and you tell the story the way you believe it from your heart, you will find someone that is keen to support you. I promise you. And it all comes down to P&L. And there are two P&Ls. There's the financial P&L, i.e. profit and loss and cash flow. What are you selling? Who's going to buy it? How much you're going to make? And equally, perhaps more importantly, what about you? What's your passion? And do you have the leadership capability to lead your team to success? New ventures. Round number 1, you're all past that. That occurred a couple of weeks ago. And there are 206 of you, I understand, that are now in the process of preparing feasibility submissions, which are short documents due May the 6th at 7 p.m. 40 of the 206 will move on to an intermediate round. And that's pitch day on June 24th, of which 25 of you, 15 unfortunately, will get left behind, and 25 will move on to the next round, which is a condensed business plan, if you will, and that's due on July 29th at 7 p.m. And then round 4 will be the top 10 pitches finale on September 9th and 10th. And party time will take place on September 27th. I don't know if we'll be able to do it as we did here 2 years ago in person, but that remains to be seen. In any event, celebration on September 27th when we announce the prizes and the winners. And let me tell you that even if you don't make it into the top 40, 25, top 10, or in the top 3, you will come out a winner by virtue of the fact that you will be able to connect with investors. Just earlier today, I was browsing through all of the competitors that have participated in the New Ventures program since the year 2000. And in that, I could spot, and I'm not exaggerating, hundreds, literally hundreds of companies that have received investment from local angel investors. The one that I mentioned at the very beginning, Abcelera, which is now the most valuable life sciences company in Canada, that company, and I chuckle when I tell you this, did not win the first prize. Actually, they got the second prize. I think it was in 2013. So, you will all be able to pop the cork by virtue of what you're going to be learning through the New Ventures program. So I want to just, again, we're getting a bit tight on time. As I said, a lot of this content is going to be available to you on the slides. So I'm just going to pass through it real quickly. You see here, that's me. Not really, but I felt like that way back when I went to my friendly BMO bank manager and I asked him for a loan because I had orders. And he said, "Show me your business plan." And I didn't have any clue what a business plan was, but I learned very quickly what it was. Subsequently, after I sold my company, one of the first phone calls I got was from the founder of BlackBerry, Mike Lazaridis, and he says, "Hey, Mike, you just made a lot of money. Can you invest in BlackBerry?" Of course, it wasn't called BlackBerry then, it was called Research in Motion. And they weren't really doing BlackBerries or pagers, they were doing consulting engineering for companies like General Motors. And, you know, they didn't have a business plan. And I agreed to make a modest investment in the company, but only because I liked Mike. And I thought someday he's going to do okay and be successful and make a lot of money. And so I negotiated BlackBerry's very first term sheet with Mike. I actually never made the investment. I moved to British Columbia and I told him that instead of using my money, he should just recruit some good people and give them shares, which is what he did. And everybody was happy, except I missed a big opportunity. But that's how it works. Anyway, business plan. A plan is better than a forecast. A plan shows what you'll achieve and how you're going to get there. The new ventures questions are going to challenge you to think about what you are planning to do. And there are many models that you can use to help you along the way, such as the business model canvas. The questions that you're going to be answering for rounds 2 and 3 are shown here. They cover the range from product to financial. Each of these could actually be a slide in a presentation, and I often encourage people to use these as guidelines for a presentation deck that you might put together. You know, you start off with the product, an explanation of what it is, and here don't make the mistake of talking too much about the technology. Talk about what it is. Lately, I've been seeing a lot of presentations where entrepreneurs start off by saying, "Here is a big problem, and here is how we're going to solve it." My advice and my preference is for you to not start off by saying what the problem is. Start off by saying, "Here's our product," and then maybe talk about the problem. As soon as I hear people talk about the problem, I think, I don't want to hear about problems. I want to hear about opportunities and products and solutions. So I am going to buck the trend here. And if people have been telling you to describe the product, my preference, but again, I'm different. I like to hear you talk about the opportunity, the product, and the service, and then tell me why it's solving a problem. Number 2, intellectual property. And that can be simply a trade secret or know-how. It doesn't always have to be patents, but you need to get a grip on your IP, and investors like it if there is IP, especially if the IP can be a barrier to entry to other competitors. Where are you in your stage of business development? Are you just at the idea stage, or pre-revenue, or are you ready to raise serious money and turn the crank and flood the market with your innovation? What's the status of your business plan? Business plans are never complete. It doesn't have to be perfect. Business plans are iterative. You're always going to be fine-tuning them. You're always going to be updating them. You're going to be revising your costing, your sales. New competitors are going to have to be addressed. So don't worry about getting it right. You know, I think it was Benjamin Franklin that said, don't waste your life trying to straighten out an arrow. It's better to shoot a crooked arrow than straightening it out for the rest of your life. The market, probably the most important question. Who is actually going to buy your product or service, and why? And don't ever say, that you are in a billion or a $10 billion market. Another popular trend is to have this Sam, Som, Tom stuff going on. And that's another, for me, it's another one of those angel BS things. I don't really care that you're selling into the multi-billion dollar automobile market. If you're selling an AI guidance system for automobiles, I want to know what the market is for AI guidance systems. I want you to define your market as succinctly as you can. I believe that that is one of the reasons why Apple has been so successful. Regis McKenna was one of the advisors to Apple in the earlier years, and I believe that Apple followed his advice that he wrote up in a seminal paper published by Harvard Business School called Marketing is Everything. Question 6, distribution. How will your customers buy it? What's your strategy for getting it to market? Competition. There is always competition. But what makes you different? What makes you better? What are the barriers to entry to competitors? What are the alternatives? If you don't think there's competition, just do some Googling. You'll probably find some. It always amazes me how I'll go to an angel presentation in Vancouver, and then I'll go to one in Australia, and I'll hear very similar pitches, and yet the companies don't know about each other. I can assure you, each and every one of you, that whatever you think your great idea is right now, there's probably someone in their basement in Poughkeepsie, Illinois, or Albuquerque, New Mexico, that's working on the same darn idea or concept. So you got to be aware of that and understand that there's always going to be competition. If there isn't, maybe no one wants what you're doing. Your team, again, very, very important. And your expertise. You know, there's Malcolm Gladwell's 10,000 hours. You need 10,000 hours of expertise to be good at anything. If you don't have 10,000 hours of business expertise, how can you get that through other participants? And your angel investors could very well be those advisors and board members who bring the 10,000 hours of business acumen to your venture. And don't be shy about acknowledging what you're missing and where you need help. To me, that's always a sign of strength, knowing where you are weak and working on that and mitigating that weakness. Everything then comes down to dollars and cents. And it's going to come down to question number 1, how much do you need? And that usually is how much do you need to get to positive cash flow? And your projections. What are your sales going to be like over the first 5 years? That is probably going to be the toughest assignment for you. And investors are really going to take you to task on that. If you have a ridiculously high number, they're going to say you're naive and crazy. If you have a ridiculously low number, they're going to say, well, this is a lifestyle business and we're just not interested in a company that's only going to do 2 million in 5 years.
Mike, I've just got a related question on this topic.
Yes.
Overall, would New Ventures BC prefer ventures with a path to cash flow positive or a high growth company but requires a cash injection in a couple years' time?
I think it's understood that, you know, growing companies are going to need cash injections. So I would lean in favor of high growth, high revenue, you know, rapidly expanding revenue. I would say the number one objective that, or let's say the number one criterion or requirement that investors like to see is a rapid acceleration of sales, dollars coming in to the company. At the end of the day, that's always what it comes down to, generating revenue and, depending how well you run the business, ultimately generating a profit. That would probably be the most important. So why do deals get funded? Well, it's because the people behind them are credible. You've got domain knowledge, especially around the market. You're realistic. You know your weaknesses. You know what you have to do to achieve your goals. You know when to use experts. You're aware of what you don't know. And you have a team. Investors will rarely invest in a one-person company. You may start that way, but over time, it'll be more than one person. You have to be in control. You have to be in charge. Investors don't ever want to see you defer to others. They want to see you take responsibility. And if something goes wrong, even if it's not your fault, they like to see you fess up and take ownership. But mainly, it's because you are liked. And investing is like a marriage. Investors have to get to know you, you have to get to know them, and you have to fall in love. So a few final tips for you. Again, don't make the claim that you're only going to get 1% of $1 billion market. I'd rather hear you say you're going to get 30% or preferably 60% of a $200 million market. Don't tell investors what you think they want to hear. Tell them what you want to accomplish. Be somewhat humble. Be careful about being too confident, because nobody has a corner on knowledge. And if you come across perhaps as a bit of a know-it-all, that can be a turnoff. Again, at the risk of emphasizing too much, show leadership and never, ever put off until tomorrow what you can do today. So if you can go home, well, you probably are at home because it's a webinar on Zoom, but later today, if there's something you can do on getting that submission done to New Ventures, especially your pitches and articulating what it is you want to do it today. Don't wait until tomorrow. So, final words. I think success is just the difference between quitting and finishing. I've seen so many entrepreneurs give up and not have the tenacity to finish. And, you know, there are those who score easily and quickly on the first time around. And then there are those who have to go through a couple of failures before they score really big. So I would encourage all of you to really roll up your sleeves and work on your business plan. I'm going to call it a business plan. Some people think it's an old-fashioned term, but you need a map. You need something that helps you figure out where you're going. And through New Ventures, we can help you do that. And then we can help you access some of that prize money if you do a good job of it. That's my presentation. It'll be available to you. You're invited to Vantech next week, as we mentioned. Even though our time is up, I'm still happy to answer a few questions. I'll turn it over to you, Angie.
Okay, great. Thank you, Mike, for perfect time presentation. That's amazing. So yeah, we'll stick around for a few minutes for questions, but we'll wrap up now. Thanks everyone for joining us. And again, we're doing financial models tomorrow. So that's more around what, the question 9, if you're in the competition, and how to model your numbers, your revenue, anything around that. So please do join us. It's just an hour tomorrow, and details are on our website. Mike talked about networking, virtual networking. I think we've got a question in our feedback survey, which will be going out shortly, if there's any interest in doing virtual networking at the end of these events. So please do answer that if you're interested or not, and we may or may not include that. So thanks again for joining us. Have a good day, and we'll stay online, and let me just see if there's any more questions here. And Mike, you're getting many, many accolades and thank yous in the chat if you haven't seen them. One question, someone was just asking for more details on Upsellera. Was that angel funded at all? And if so, what was the attraction?
Yeah, that's one of the ones I missed out on. Unfortunately, I didn't get involved with it early on. But I know of a few people that did. Um, and I unfortunately don't have a lot of details that I can share with you.
All right,
Do you
Justin,
know, Angie? Do you know from New Ventures what?
who got involved from angel level? No,
Yeah.
no, nothing to share. Justin, I think you have your hand up. Do you want to ask yourself?
Yeah, can you hear me?
Yep.
Great. Well, thanks for the presentation. Very valuable. So thanks for your time. My name is Justin. I'm from Movement App. Happy to share the stage with all these other great companies. Just going back in your slide deck to the National Angel Capital Organization,
Yes.
you spoke to the median and mean valuation for
Yeah.
the 2019 survey. So is that like a broad measure of startups that are both pre-commercialization and like
Yeah.
into generating revenue, or is it a specific subset? Like, I'm curious,
No,
just as I'm building my
it's a
valuation model for our company.
it's a very broad average, and the valuations this year, or for 2020, I should say, are probably higher than this. So this is the slide that you're referring to. But we are seeing valuations even getting close to $10 million. Um, there's an excellent YouTube put out by an angel in Seattle who talks about the idea that, and I totally believe this, the idea that on each round that you're raising, regardless of how much money you are looking for, you're going to have to give up between 20 and 40%. I think I actually had it in one of my slides, I said 20 to 30%. So if you're looking for, say, $1 million, then you're looking at a valuation of, say, around 5 million, say 4 million, 5 million, something around there. If you're raising 2 million, you could be looking at a valuation of 8 to 10. So it's kind of strange when you think that the amount you're looking for drives the valuation. But there's a good reason for that. It's because it has to do with participation. You know, you're bringing something to the table and the investor's bringing something to the table. So you're bringing something that, let's say, needs $1 million to get to first base. And so you need the million, and the investor has your commitment to do your part of that. So it's a matter of sharing that pie. And you're saying to the investor, well, for your million, I'll give up a big chunk, and that chunk could be 20, 25%. And that's really what drives the ultimate valuation. And even though a lot of people don't like to admit that, that is really what's happening. And it's market driven. You know, and by the same token, that range will vary, as I explained earlier, depending on what city or location you're in.
All right, Clay is asking, what do you look for in an exit strategy? And I'll preface that also just to say that we do have David Raffa coming on later to give an exit strategy talk as well.
Yeah, so, and you know, different angels will have different views on this again. But I think everybody wants to know roughly how long their money is going to be tied up. Because, you know, unlike investing in a public company, when you invest in a private company, you're stuck there. You can't just call the company and say, hey, I want to buy a new car. Can you cash me in? It just doesn't work that way. So people know that they have to be patient, but they want some idea as to time frame. But also they want to know ultimately, where's that money coming from? You know, who specifically might be some of the companies in your industry that could be interested in acquiring the company? Or are you so ambitious that you want to build a huge enterprise and ultimately go public? And instead of you being acquired, maybe you're the one that's going to acquire other companies and really build a substantial enterprise. So these are all factors to consider.
Okay, I think we've got 2 more questions and then we'll call it a day here. Oh, Anthony's, I guess, pitching at Vantech next week, wants to know if you have any tips or things to focus on in the 90 seconds.
Well, as a starter, use that slide that I mentioned about the, actually both slides, the elevator pitch and the investor pitch, but avoid, try to be specific. A big problem that investors have is understanding what you're doing. I have to tell you that about half of the presentations that I hear, I don't get in the first 1 or 2 minutes of the presentation. They start off, as I said, with talking about problems that they're solving. Or maybe they start off with competitors. I just want you to say, here's what we're making, here's what we're selling. And then right away, I can form a picture. So tell a story that puts a picture into the mind of the investor. That's the best advice I can give you on that.
Okay, that's
Thank you very
great.
much.
All right, and finally, Ben is asking if there is a company with multiple team members, does the CEO or founder need to have full control of the company to be attractive to investors?
Yeah, now when I meant control, be very careful. I meant being in charge as a leader would be. I don't mean control in the sense that you can do whatever you want because you own most of the shares. And we didn't have time in the webinar to cover it, but investors will want to take some control away from you. In fact, I can tell you that even though you may still have more than 50% ownership of the company, you are not going to be able to do whatever it is you want to do, because your investors are going to want to have a shareholders agreement where you agree to abide by certain things that you negotiate with the investor. Like, for example, that you're not going to give yourself a really big paycheck, or that you're going to run out and spend the money on something that you didn't agree to spend it on. Or most importantly, your investors are going to want to see a board of directors, and they may want to put somebody on that board of directors. So they will want you to have limited control in terms of ultimate decision making, but they want you to be confidently in charge of running the business on a day-by-day basis and relying on your board whenever there's a decision that requires, let's say, a major financial decision that's required.
All right, I think that's it. That's a wrap. Thank you,
Awesome.
everyone.
Thank you very much.
Yeah, thanks, Ben. So thanks again, Mike, for staying a little bit
Great.
over time. Thanks to everyone. You had 60 people pretty much stay overtime with us. So yeah, lots of good information here. So thank you again, Mike. Thanks everyone else for joining us. And
My pleasure as always.
Great, thanks, Mike. And I'll figure out the guest list for Vantech with you. I'm sure some people will email you, and I'll send you a list of anyone I get as well.
Okay, great.
Okay, thanks everyone. Have a good afternoon. Bye. Thanks, Mike.
Bye-bye.